Hey there, welcome back to our channel. Today, we have an exciting topic to discuss, one that might raise a few eyebrows. We'll be diving into the concept of using debt to make money. Now, before we proceed, it's important to note that handling debt can be risky, and it's crucial to approach it with caution and careful consideration. With that said, let's explore 5 points on how debt can be utilized to generate wealth. Remember, this is not financial advice. Before we start, please like the video and subscribe to the channel. 1. Leveraging debt for investment opportunities. Debt can be an effective tool for capitalizing on investment opportunities. By borrowing money strategically, you can gain access to capital that can potentially yield higher returns than the cost of borrowing. However, this approach requires thorough research, analysis, and a disciplined investment strategy. Consider an example. You come across an investment opportunity with great potential, an innovative startup that is poised for exponential growth. However, you lack the necessary funds to invest. Instead of letting this opportunity slip away, you can consider taking on debt. Begin by evaluating the terms and interest rates of potential loans or credit lines. Look for low-cost options that align with your investment horizon and risk tolerance. If the potential return on investment is significantly higher than the interest you'll be paying, it might be worth considering taking on debt. Exercise caution by conducting thorough due diligence on the investment, assessing the associated risks, and having a solid plan for paying off the debt. Always remember that investments come with uncertainties, and there's no guarantee of returns. 2. Strategic debt for business growth. Debt can also play a crucial role in fueling business growth. Many successful entrepreneurs and companies have effectively utilized debt to expand their operations, invest in new technologies, or seize market opportunities. Consider a small business owner who wants to expand their company's reach by opening a new location. The upfront costs for purchasing or leasing property, renovating, and hiring additional staff can be substantial. Instead of draining personal savings or limiting growth potential, the business owner can consider securing a loan. Approach this strategically by carefully calculating the projected returns and assessing the potential risks. Create a comprehensive business plan, outlining how the borrowed funds will be utilized and the expected impact on revenue and profitability. This will help you present a compelling case to lenders and increase your chances of securing favorable loan terms. Ensure that your cash flow projections can comfortably accommodate the loan repayment schedule. This way, you can maintain a healthy financial position while capitalizing on the growth opportunities debt can provide. 3. Debt consolidation for financial efficiency. Debt consolidation is a strategy that involves combining multiple debts into a single loan with a lower interest rate or more favorable terms. This can help individuals or businesses streamline their debt management and potentially save money in the long run. Consider a scenario where you have several high-interest debts, such as credit card balances or personal loans. Each debt comes with its own interest rate and repayment schedule, making it challenging to keep track of payments and potentially leading to higher overall interest costs. By consolidating these debts into a single loan, you can simplify your finances and potentially reduce your interest expenses. Look for loan options with lower interest rates than your current debts and favorable repayment terms. This can allow you to make a single monthly payment, which can be more manageable and help you stay organized. However, exercise caution when opting for debt consolidation. Ensure that the new loan terms are indeed more favorable and that you can comfortably meet the repayment obligations. Additionally, consider the potential impact on your credit score and seek guidance from financial professionals to determine if debt consolidation is the right strategy for your specific situation. 4. Using debt as a business tool for cash flow management. For businesses, managing cash flow is crucial for ongoing operations, growth, and profitability. Debt can serve as a valuable tool to address short-term cash flow gaps and seize opportunities without disrupting the company's financial stability. One way businesses can utilize debt for cash flow management is through a business line of credit. A line of credit provides access to a predetermined amount of funds that can be drawn upon as needed. It allows businesses to cover expenses, manage inventory, or fund projects during periods of reduced cash flow or unexpected expenses. Having a business line of credit in place can provide peace of mind and flexibility. It enables you to navigate through seasonal fluctuations, take advantage of supplier discounts for bulk purchases, or invest in marketing campaigns to drive sales. However, responsible use of a business line of credit is crucial. Avoid excessive borrowing or relying on it as a long-term solution. Develop a clear repayment plan and ensure that the borrowed funds are used strategically to enhance business operations and generate a positive return on investment. 5. Using debt against your investments. Another way to utilize debt to make money is by leveraging your existing investments to secure loans or lines of credit. This strategy allows you to unlock the value of your investments without liquidating them, enabling you to access funds for other purposes while your investments continue to grow. Consider a scenario where you have a well-diversified investment portfolio that has appreciated in value over time. Instead of selling your investments and potentially incurring capital gains taxes or missing out on future growth, you can use them as collateral to obtain a loan or a margin account with a brokerage. By borrowing against your investments, you can access a portion of their value and use the funds for various purposes, such as financing a business venture, purchasing real estate, or funding personal expenses. This strategy can be particularly useful when you believe that your investments will continue to appreciate and the potential returns outweigh the cost of borrowing. However, it's important to exercise caution when using debt against your investments. Consider the following key points. Loan-to-value ratio. Lenders will typically limit the amount they are willing to lend based on the value of your investments. Ensure that the loan-to-value ratio aligns with your risk tolerance and that you have a sufficient buffer to protect against potential market downturns. Interest rates and terms. Compare different lenders and loan products to secure the most favorable interest rates and terms. Look for options that offer flexibility, competitive rates, and repayment schedules that align with your financial goals. Risks and margin calls. When using margin accounts, be aware of the risks associated with market volatility. If the value of your investments decreases significantly, you may receive a margin call, requiring you to either repay a portion of the loan or provide additional collateral. Understand these risks and have a contingency plan in place. Investment performance. While using debt against your investments can be an effective strategy, there are no guarantees in the market. Ensure that you have a thorough understanding of your investments and their potential risks. Be prepared for fluctuations and have alternative repayment sources in case your investments do not perform as expected. Utilizing debt to make money requires careful consideration and strategic planning. Whether it's leveraging debt for investment opportunities, using it for business growth, consolidating debts for financial efficiency, or utilizing it as a tool for cash flow management, always approach debt with caution, conduct thorough research, and consider your unique circumstances. As with any financial decision, seeking guidance from professionals and evaluating the risks and potential benefits are essential. Debt can be a powerful tool, but it must be handled responsibly to ensure long-term financial success. Thank you for watching. Please like the video and subscribe to the channel.